Hello, today I have with me John Butler, who is the author of The Golden Revolution and also the CIO of Amphora Commodities Fund. Thank you for joining us today.
Thanks, Jan.
I really enjoyed your book. I thought it was really accessible for people that are interested in investing and already are aware that the fiat system is on its way under, as it were, and sort of asking questions about how it may come about or what they can do next. So I really enjoyed the book, and I definitely suggested lots of people asking what they could read in this area.
Thank you.
What I'm curious about is how you originally came to sort of writing the book and what got you interested in gold and the fiat system, as it were.
Well, my background is as an interest rate, currency, and also commodity strategist. But the commodity part was actually the minority part. And the fact is, when I worked for banks and investment banks, I was primarily supporting the interest rate function and the currency function within the bank. And so the vast majority of the research I did and the research I published was on interest rate and currency markets. And commodities was just sort of an appendage.
Right.
But as you got into the early 2000s and interest rates fell very dramatically in all major economies, I started asking the question, what does this imply for relative currency values? For example, everyone assumes, and I think this is under normal circumstances a correct assumption, that interest rate differentials or expectations thereof are a critical input into thinking about what exchange rates should be, what's fair value. And people have elaborate models for this sort of thing. But as interest rates approach zero, not just in one country, but in most countries, well then, what on earth is going to determine currency movements? Because there is no differential left. Rates are essentially zero everywhere. And that's what leads you into the commodities arena. Why are interest rates at zero? Because policymakers are trying to reflate economies. They're trying to create inflation. They think that's a good thing, apparently. But if you want to protect yourself as an investor, and you can't move from currency to currency, because essentially all interest rates are zero, well, you're forced to think about an allocation to real assets, to commodities, and naturally, historically, gold, being money, or silver, alternatively being money, have the most direct claim to being that alternative monetary asset in the event that interest rates for paper fiat money just aren't attractive anymore.
So as I said, I really enjoyed the book. What kind of response have you had to it so far?
Well, quite a positive response. The timing is pretty good because gold is in process of moving, or gold standard, sound money, is in process of moving from what you might call a fringe topic in finance to a more central topic. And don't get me wrong, it has a long way to go, but there's been a lot of movement in recent months as more and more policy officials are being forced to at least discuss the topic. They might still disparage it, but at a minimum they feel required to weigh in on it. You've had some prominent investors talking both sides of it. The debate is clearly advancing. And I like to think that my book is well positioned to contribute to that debate in a way which is, in certain respects original, and in certain respects pulling some of those various strands together. Ultimately it's got my own stamp on it about what I think about it and where I think it's going. But at a minimum, the book's being well received as a contribution to that debate, a very healthy debate. Let's face it, the sunlight exposes the lies for what they are, and brings the truth, or makes the truth more evident to everybody. So I fully welcome the debate around gold.
So taken from that, this debate is hotting up and it is moving into the mainstream. And your book, sort of, as we were just saying, it shows that the move to the gold standard is inevitable. But what I quite liked is you say it doesn't have to be about the first mover into the gold standard. A lot of people comment on when America moves to the gold standard. There's a lot of heat around Ron Paul running for the Republican presidency. But you say it doesn't actually have to be a first mover, and I think we are seeing that now with various economies expressing their interest in gold and trading gold. How do you think that the sort of process is moving forwards, and how do you think that will affect the global gold standard?
I think that's certainly one of the more original contributions of my book. And I think one reason it is original is because we live in this world where we've been conditioned to believe that everything that happens in economics is because some policymaker changed this or that policy, or whatever it was.
But can I say that's not actually how we even got into the gold standard in the first place?
Well, no, that's right. The classical gold standard was not, by design. It's not as if a bunch of people got together in a room one day and decided, gee, isn't this a good idea? Let's have a gold standard. Yeah. It arose very spontaneously from the bottom up. Just simply because that's the way the international system was developing at the time. It was a very multipolar system where all of these countries were trading more and more with each other but they still couldn't fully trust one another. They'd been at war from time to time. Who knows, they might have big disputes down the road. And the understanding was nobody was willing to just accumulate someone else's reserves as currency, with the risk that it might be diluted, capital controls might be imposed, who knows what it might be. Everyone preferred the trust, the credibility of gold back then. Well, guess where we are today, right? There's a breakdown in international cooperation. The USA used to be a very hegemonic power in a position to impose terms on others. Now, you could argue that following the Second World War, the US was a benevolent hegemon in many ways, helping Europe to reconstruct, helping Japan to reconstruct. But then you move on to where we are today, where the US economy is far smaller relative to the global economy, where its economy may also be less competitive relative to much of the global economy, and US monetary policy decisions don't necessarily line up very well with what the rest of the world would like to see. So we could well be seeing this sort of spontaneous process where more than one country at a time are all just sort of collectively realizing that they need to change the way they behave. And they may not be coordinating anything, but it leads you back towards some form of gold standard.
And but at the same time in your book, you argue that you say that there's a financial incentive to not change the system. I think particularly on the side of the Americans. So how do you see that? How do you see them managing if, say, the BRICS, as they said in their 2011 report, they released a statement saying it was time to start looking at a new monetary system. How do you think the US dollar, US government will manage this change?
Well, it could be very disruptive. And indeed, let's face it, monetary regime change is disruptive. Look at history, it's disruptive. Yeah. Now that said, it tends to be associated with wars and revolutions. I mean, fortunately, right now, there are not major wars and revolutions going on in the world, but nevertheless, the immediate issue of monetary regime change is increasingly plain for all to see. There is pressure to move in this direction. But the U.S. has the most to lose, right? The U.S. has a relatively weak economy as a result of various structural imbalances that have built through the years. It has a huge chronic current account deficit that is being financed by the rest of the world. But what does the rest of the world get in return? If U.S. monetary policy does not conform to what they need and want and prefer, why should they put up with this arrangement where they effectively export hard goods to the U.S. in return for pieces of paper?
Yeah.
It's not a stable situation. So the U.S. will resist it because they have this exorbitant privilege, call it whatever you want, of being able to print dollars into existence, give them to the rest of the world, and import actual goods. But the rest of the world is pushing back on this now. And the U.S. will at some point simply be forced to face the music.
So, but maybe sort of finding middle ground, this is something you do address in your book. In 2010, Robert Zoellick came out, this is just about the time I was getting interested in gold, and he was suggesting that gold was brought into the basket of currencies that make up the SDR, the special drawing rights. But you don't think that this would be an appropriate new sort of reserve currency, do you, for us to back on, despite the BRICS writing that they would consider, the use of the SDR as a reserve currency?
I think it's only natural that bureaucrats are drawn to bureaucratic solutions to problems. And I don't mean that bureaucrats don't mean well, but what sounds good on paper when you're in a conference room and you've got, you all understand that you represent your countries and you all feel very powerful and important. What sounds good on paper in that context may not work particularly well in the real world. And Exhibit A is the euro area.
Yeah.
On paper, the euro sounded brilliant, but the problem is that one currency has not suited all. And there's been an implicit moral hazard problem in the system. There's been this sense that you could have local property bubbles or asset bubbles in various parts of the euro area, and it wouldn't cause the system to break down. We now know, of course, that it doesn't work that way, and that for the system to continue to exist as designed, it will have to have an inflationary bias. This is why everyone's calling on Germany to inflate.
Yeah.
Oh, that will solve the problem. Well, yes and no. It'll solve the immediate problem and create a bigger problem in the future.
Yeah.
The SDR is just the euro writ large at the global level. It's all these countries coming together and saying, okay, we'll effectively have a single currency. It'll all be tied together. And we'll agree on a common monetary policy by default. And it will be implemented by the IMF or some related organization. Again, it sounds nice on paper, but it won't solve the issue of local asset bubbles, economic imbalances, and the way those will have to be resolved is through inflation. So if anything, it will simply take what is already an inflationary bias at the national level, turn it into an inflationary bias at a supranational level, where the amount of cooperation required to hold it together is even greater than the euro area.
It requires greater regulation.
Exactly. It's not going to work. I mean, in a world where all countries were already getting along very, very well, maybe it would have a long lifespan.
And surely on similar fiscal footing as well.
Yes, exactly, with similar interests and everything else. That's just not the world we live in. There's too many geopolitical rivalries, there are too many imbalances that already exist that would not be resolved by this in a way that's attractive enough to the main players. So it's a non-starter in my opinion. It would blow up almost as soon as it was introduced, whereas gold, as something which could not be manipulated, which would not have an inflationary bias, would be a far more durable and stable system, and a more equitable one.
Okay, and just moving on to sort of more current events like the euro crisis, bank bailouts, you've been commenting quite a bit recently on the potential of gold being used as a tier 1 capital asset. I understand the Bank of International Settlements have been lobbying for this to be the case. Just be interested to hear
Banks have been lobbying the BIS for this to be the case.
Banks.
Yes, that's right.
So I would just be interested to hear a bit more about that, because it's not something we've been hearing much about in the mainstream media.
It's a bit of a technical point, but an important one. It's important in what it represents.
Yeah.
The BIS, as you know, sets the capital requirements for the banks around the world, and the idea is that so-called tier 1 assets are ones that banks effectively don't have to hold any capital against whatsoever.
Yeah.
So when a bank becomes capital impaired, it normally has two choices. Number one, it can raise capital by issuing shares, subordinated debt, whatever it is that raises its tier 1 capital. But of course, if you get into a really risk-averse environment, it's very difficult to do that because your shares are already so undervalued. You're diluting your shareholders extremely by doing so. So you get into a situation where that's an extremely difficult thing to do. So the other option, when you get distressed, is you simply have to sell assets with a high risk weighting and accumulate assets with a low risk weighting. The lowest risk weighting is represented by the highest quality government bonds, and the higher risk weighted stuff are risky loans, risky securities, with gold being in the middle, effectively.
Yeah.
But if gold were zero risk weighted, i.e. it competed on a level playing field with government bonds, then it would be nice for the banks. They would have a larger pool of these tier 1 assets to draw upon, and that would help them improve their capital coverage ratios without having to drive interest rates down even lower than they already are, which of course constrains their interest margin.
Yeah.
So banks would love the flexibility to acquire gold positions. Impaired banks would. But do governments want them to be able to shift out of government bonds into gold, something which could, of course, raise government's own financing costs? So there's a bit of a clash going on here.
Because at the moment the opposite is happening, they're selling the gold in order to buy the government
Exactly,
bonds.
that's right.
But if this was allowed, surely this would mean great things for the gold price for those gold investors that we have out there?
I think so, because you've effectively had forced selling of gold as banks have become more and more capital impaired. I mean, even if banks themselves didn't have gold on the books, if it was a bank lending to a shadow bank system entity that did have gold on the books, and banks have to pull that credit line to, again, improve their capital ratio, well, that can result in forced selling of gold. So you've had a lot of forced selling of gold. It's one reason why gold fell back to around $1,500 an ounce recently, even though it's bounced in very recent days. But one reason why gold has not been behaving as a safe haven asset is because of this technical regulatory factor, which may not be resolved anytime soon, but even if it isn't resolved, if policymakers rewrite the capital rules to give banks more flexibility, which is what they did back in 2008, then gold can snap back very high or very quickly, perhaps something we're already beginning to see.
I was actually going to ask you about 2008, because as you just pointed out, we've seen quite a drop in the gold price recently, since the beginning of the year. And do you think we're maybe seeing a repeat of 2008 slightly with the gold price, where it drops again there?
Well, indeed. In 2008, as things were going from bad to worse, the price of gold dropped very significantly. But when you step back from all those charts of gold, shares, interest rates, and everything else, it's very clear that once markets realized that policymakers were finally going to effectively rewrite the rules, relax mark-to-market requirements, relax capital requirements, basically backstop the system with various forms of central bank or sovereign guarantees, the very first asset to recover was gold. And I think we're quite likely to see the same pattern repeated this time around.
So taking on from that and sort of talking to our investors, what as you say, return to the gold standard is inevitable. Perhaps not tomorrow, but it certainly is inevitable. So, what in your book you talk about this? What can investors do to prepare for the inevitable gold standard, the return to the gold standard?
Well, the simplest thing to do, of course, is to be overweight real assets, including gold and silver, because part of this process of getting back onto a gold standard implies a substantial degree of fiat currency weakness. There is simply no way you can restore stability and credibility to the international monetary system without a dramatic deleveraging. But that deleveraging, again, if policymakers won't allow it to happen in deflationary terms, it happens in inflationary terms.
Yeah.
And it means that the price of real assets, gold and silver, is going to be an order of magnitude higher in order to deleverage the system effectively. So we're talking sort of $10,000 gold,
Yes.
or even higher, depending on just how much deleveraging
I think
takes
10,000
place.
is the amount you give in your book, isn't it? Sort of
Actually, I say 13,000, but 13,000 just sounds a bit less round. But
Yeah.
actually, if you are trying to come up with a number which draws a historical relationship between the supply of money and the price of gold, that number gets you closer.
That way
That's right. So 13,000 actually gets you closer to what I think would be a reasonable end game. But while that may sound, it's completely out of line with reason, it's like, oh, can you really forecast such a high gold price? Just, look at the numbers, look at the charts, look at money supply growth, look at credit growth, look at the leverage in the system. Those are the numbers. This is how out of control policy has been cumulatively since we left the gold standard. So if you're going to go back on it, we've got to correct for all of that. So this 13,000 price is not
an unreasonable price.
No, and in fact, were I to become speculative in this regard and say, well, actually, there's going to be a whole lot of economic damage done along the way, then you would need an even higher price. This is assuming the transition is smooth and orderly. That's the sort of price you get to.
Okay, so we said to investors that get in with your gold and silver in preparation for this higher price. And what do you think? I mean, I would never recommend that everyone goes all in on gold. So what about things like property, stocks and shares? I mean, how will they be affected in the...
Well, before we get on to property and stocks and shares, think about other commodities. I mean, yes, currencies may be printed as systems deleverage. That's the way it's probably going to be done. But you can't print oil, so the oil price goes up as well. The world still needs it to function. I mean, even if the global economy is not growing, that doesn't mean you're not using any oil. Just to maintain zero growth, guess how much oil you need to consume. So, I mean, there is still going to be a price for oil. And if you're printing money against it, that price will go up. The same is true of other consumable commodities. Grains will still be in demand. Various other soft commodities will still be in demand. Various metals will still be in demand. So commodities more broadly should do reasonably well in this sort of environment. Property, the problem with property is that property became a bubble. There was too much housing, for example, built in the US. And where there's too much supply, prices have to adjust lower. Now, property may be a real asset, but a real asset in fundamental oversupply will not perform as well as a real asset which is not in oversupply. That's exactly right. So I think there are pockets of value in the property market, but do your homework. I don't think just buy property and expect it will always and everywhere go up is the best strategy. I think it's safer to focus on the monetary assets like gold and silver that are going to get more leverage out of the remonetization process that lies in the future. And then shares, same thing kind of with property. I'm sure there are pockets of value in the stock market, but what is a corporation? A corporation is a bundle of highly complex processes, a value-add chain that begins with raw commodities, say at the one end, and some fancy widget on the other end. And all of these steps in between that take you across borders, that incur tax liabilities, that incur risk around various operational activities, step by step. Ultimately, they're highly geared to all of these highly sensitive things. If you believe that the global economy is fundamentally over-leveraged, and that the deleveraging process can be disruptive, that it will result in perhaps weak end-user demand for some period of time, these highly complex corporations are hugely exposed to these disruptions along the way. Whereas the raw commodity inputs will still be in demand. So I think share prices are not yet adjusted low enough for this rough deleveraging and transition period that lies ahead. They've come down, they're more reasonable than they were, but I think the raw commodities themselves offer better value from this starting point than either share prices in general or property in general.
And going on from property, most people buy property with a mortgage, and how, when we return to the gold standard, how will this affect interest rates, do you think?
Well, the good news is that once you get back onto a gold standard, interest rates will no longer be set by a government agency that may or may not know what it's doing. More likely not know what it's doing, if you ask me. They'll be set by the market. The market will set its own interest rates. As demand for credit increases, interest rates will go up. As demand for credit decreases, interest rates will go down. I mean, if you have fundamental faith in the free market, then of course you don't want government setting the price of widgets or soap or a car or whatever else. Well, why should the government set interest rates? It's the price of money.
Yeah.
And unless you're trying to manipulate it for reasons which may be self-serving, which may serve the political cycle, who knows? If you actually believe in the free market, there is no reason to manipulate interest rates.
Yeah.
And so once you're back onto a gold standard, you're basically throwing the power of interest rates back into the marketplace. That's probably a good thing.
Yeah.
And that means that interest rates will be determined in a way which, again, it will be under no one's control, but should allocate capital more efficiently over time. And that will be to every...
Competition in interest rates will be allowed.
Competition will be allowed. And it will simply mean that capital is likely to flow from where it's not being efficiently used to where it is being efficiently used much more easily without these manipulation effects. It means just in general productivity and just the underlying health and stability of economies will be that much higher under a gold standard.
Thank you very much. I've really enjoyed it, and I think we've shown in that interview just quite how rounded and yet positive a view you give in your book. And I felt that rather than say go all in gold and everything's over, you've shown that we still need to be balanced about things. The world will still go on when we eventually reach gold, and that's really come across in this interview. Thank you very much for your time today.
Thank you, Jack.